All right, so what do you need me to do?
Go back to December of 18, you said?
Yes, because that's when gold started to perk up. So I was
Okay.
curious to see what this was picking up, December, January. December of 18, January of 19.
Is that
Okay.
13? What year is this? 18 here.
I don't know why I can't see the bottom on it. I can't see the.
Right here. There's November, there's December.
Well, what you
Okay.
had here, and I'm not sure the date here, but you see where the implied volatility here, somebody started buying big time here. But it didn't hold. It came back down again. And what you're looking at here is that you're starting to look at implied volatility, but there's a lot of interest here. And I don't know what happened here, but it created a new one-year high for a while. And you can see that clearly the implied volatility was higher. So you were already paying. Now, if you look at this one place down here where you have one bar red, that at least tells you at this point that the implied and historic volatility were right in line at the same time. And it's me, I would, if this was on mine, I just enlarge the whole thing. So
Is this here or is this over here?
What's that?
Which one am I looking at? The December? Right there?
Well, I was actually just looking at how it developed. And here you can now you're getting further along. Here was this big move down. You see how the historic volatility and the implied volatility both went up, and you'll see that when it topped.
Grab the mouse and show us, Stan.
I can't because I can't get the bottom of the chart.
Okay, hold on. You know what I can do? I will, let's see if I can squeeze the chart.
And Stan, the only reason I picked this, December of 18, January of 19 time frame is because, as you can see, that was the start of the move in gold. So I wanted to see, what your volatility metrics looked like back then.
Okay. I can open this up. I just needed to be able to see the bottom to be able to scroll. So let's go back to 18 again. And this would be
that's May
19.
There it is.
August.
That's August.
Keep going.
All right.
Those red ones. The next cluster of red is December. So that's November and then December.
Okay. So I'm just going to put, I see it down here. Okay.
Okay.
So what I'm actually looking for is what caused everybody to start buying here. But this implied volatility is an indication that, there was a large spike. And the way we do the normalization, we drop off the current month 18 days before to avoid spikes that are connected to expirations. And so that's part of the normalizing. But here we're not looking at any particular, this almost validates what you're saying in that this is showing you that people weren't really buying all that many options. Down here, we actually got to the point where they were cheap. And this is the same one as the other one. When you see a blue dot up here, we're looking at low volatility on a 4-year basis. So you really didn't get any interest in this until you started to get here when you started to see the volatility break out. But you'll notice it's still nowhere close to the high that was made back here. So if we slide this thing down, now you see historic volatility getting really high. And that also that's an indication on the cash price, we may be getting close to a top of this up market that we have here. And we started to see it started to go sideways. Sideways brings the volatility in. And basically, we started to get up here. We started to get up to 20% volatility. This is the only dot we got on this whole thing. So we never saw people excited about buying the options yet. They're getting.
So Stan, look, if I may,
Sure.
so what they were doing was buying protection in a generally rising gold price. Is that what this is saying?
Well, you can't make generally. Yeah, I would say that when you buy options, it doesn't matter whether you're buying a put or a call. You know, volatility itself is without direction.
Right.
And,
Okay. Right.
and even to be more specific, in many markets, and sugar is a great one, it doesn't have a very good put market at all, but it's got a strong call market. And the gentleman that I taught with at NYU, who happens to be he's a mathematical, he's very, very bright theoretical mathematics, and he's been gifted with a photographic memory as well for numbers. And so he was dangerous in the pit. But, you know, when we were teaching, we would talk about the fact in sugar that he taught the industry that if you want to buy a put and I can get it done by buying a call and selling a futures for cheaper, then I'm going to do it through the call. So buying a put or buying a call really is the same thing. The key to options is whether you're buying the options or selling the options. So if you buy a call and sell a futures, you just bought a put. So the synthetic relationship here sometimes changes, and a lot of it depends on whether you're looking at an agricultural or not. But here you do see the volatility was starting to get up there. So people were buying, and I would guess that there was probably, and you'd have to take a look at the numbers, but they could easily be buying protection. Because you're getting into the fall where a lot of jewelry places are buying for the Christmas season, and they'll buy puts to protect the gold that they bought. So if gold falls, you know, they don't have to raise the price of jewelry to cover their loss. So yeah, this is probably pretty common in this area, especially after you've moved up, that the people were protecting the value of the product that they were doing for fabrication of the holidays. And then the market started to go up again. And now I would say that when you started to break out here, this is probably the first place where you started to get heavy call buying. And you can see that the implied volatility is way above the historic. So when you see this here, it means that the people buying options are expecting the volatility to go up. Not necessarily a direction, but they're expecting volatility to go up. And they're playing a direction. Now what I've done, go ahead.
No, I was going to say, now I get what you're saying, because that implied volatility is just the net effect of the puts and calls.
Yeah, people are willing to pay. They're hitting the offers. They're willing to pay more because the higher the volatility, the wider the trading range is. It's being projected. Now, what I have done here, and I'll move this down for a second, is that I can go to our options window, and let's just take a look at gold for real quick, and do last. And let me just mark this down so I can put it in. 33 days to go, and I have a volatility of 18.6. So to help a person, especially a person who may not even be looking at options, is I built this in here, and I think this is one of them. Let me see. Yes. I built a study in, and you put in 33 days and then put in 18.6. And this one you can do with every single month because you have a different days to expiration. And now I can tell you, well, now I'm going back to where we are today. I can tell you that based on where we settled today, if you were to have bought the second month out, this is the trading range that's being projected with this particular implied volatility.
Gotcha.
So now one can take a look at the chart and say, well, do you think it's going to break out of this trading range? If you do, then, you know, buying options may be a good choice, even though it's high, but it's, you know, interesting. And the other thing, as I mentioned before, look at this. It broke out and the market's been up every day. Look what happened to your historical vol. It fell because volatility is a two-tailed test. And if the market's going in one direction, it's one tail. So when you calculate that, it's actually the historical volatility is going down because all the movement's in one direction. So that's something else that you have to be. Now, if I go to a 10-bar historic volatility, it looks a lot different. Now the historic volatility is only going back 10 bars. But again, when you see these marks up here, these are high levels based on a 4-year look back. So this means the market it's very volatile down here. And it's obvious. It went down, went up, came back down, went back up, and now it's starting to go sideways. So the volatility came down. Now it's starting, it held the cloud, and now it's starting to go back up again, but it's almost all unidirectional. And the more unidirectional it is, the harder it is for the historic volatility, for the implied. So the implied is implying a larger, people are willing to pay, but you can tell they're directional. They're buying calls. And people are selling puts, and the people say at this level, if this market comes down, who has to be protected? It's the put seller that's looking for the most protection. Because he's at risk if the market comes down. So when you see the options are being bid up, you have to remember the person with the most risk is the seller. So they're trying to get a little more protection in the options that they're selling.
Yes.
And this has been normal distribution. And this is still starting to come up. But when you start to put this into perspective, you can it's still low. It's still relatively low going back just 1 year. And the other one would go back 4 years, and it would show you, the different extremes. But when you see this, it's normally the end of a trend. And look where it occurred. It occurred right about here. We had been moving up, and we had a pretty significant correction, and the volatility came down. And then it went back up again because we had another rally. Now we really have a large trading range because we had a significant down move and a significant up move. And there's where you start to get the high volatility on a 4-year perspective. And again, what it tells me more than anything else is this really isn't a great place to be buying options. Even if I want to see a breakout here, I would be more apt to try to look at buying one call, selling another call against it. You cap your profit, but you lower your costs because you're doing a spread.
So now, if the gold move were coming to fruition, we would expect to see what? The historical?
Yeah, we
cross up above the implied?
Both of them should start getting some dots up here. Or at least move up. Sometimes these things, because you had such a violent move down and then back up, you got an abnormally high volatility. Sometimes you have to look at what the normal volatility had been which would be right around here. And we like, you know, if you start to see the volatility get up around there, you know, you may be starting to look at some exhaustion. And, you know, you'd like to see this one go up as well. But again, it may not be, well, it could be as high on the implied, because remember, the implied volatility is determined by market price. Implied volatility is a statistical measure of standard deviation. So if you see the blue line going up, it means people are still buying. But at the end of a trend, it's usually the speculators are buying and the people with knowledge are selling. But you get a two-way action. You're getting, you know, you're getting a lot of action in two directions, and that expands your trading. You know, the trading range that's being projected by the implied, and that's why I did these studies to show you what the trading range would be based on whatever implied volatility and days to expiration you were looking at. And you might be, you know, if you open up your options window again, you may be looking at, well, August only has 4 days left. October is a great month to trade only if you're trading against platinum. The big one is going to be December. November, it gets a trade every month because the settlement for the odd month tends to be equivalent, the American equivalent to the London fixed price. So you have to look at the volume on some of these things that are being traded, because it doesn't actively trade every month. And the easiest way to tell which months you want to look at would just be going to all cons and put up the gold, and it's, you know, July, August, Sep, Novi, Dece, and then you go to Feb, April. Those are the ones where the futures expire, and therefore you have your highest volume in the options, in the underlying. However, there are a lot of strategies now. Let's just say you bought December calls. You could sell Sep calls against it. You could sell October calls against it, November calls, where you're getting advantage of the time decay. Well, the October has its own futures. But you'll notice November and December go off December. And January and February go off February. So there are opportunities there to collect time decay on the front ones with very little risk. They're called serial options, and because if you go out any further, you get basis risk because the underlying is two different contracts. So you have to be aware of the spread between the two futures contracts that you're actually looking at. Whereas if they're serial options, you don't have that. The underlying is the same for both. That's been the popularity of the weeklies. And, you know, in the mini S&P, you have weeklies, monthlies, Monday expiration, Wednesday expiration. No other commodity has that many choices, but there you basically have an option every 2 days that expires. So, you know, we've had people playing over the weekend. Crude oil has I think a Monday, Wednesday. I had a refinery that was just protecting their inventory over the weekend, and they would buy an option that you know, put on Friday, took it off on Monday or Tuesday. So they keep adding. They did the same thing in the stock market. They have, you know, they got so many different series of options for every symbol. Well, EP has done the same thing. Gold, not so much. But what I just do, because I wrote this thing, whoops. No, I'll open that back up. Well, we'll go. We won't change it.
Might be down in the corner, Stan.
Yeah, it is, but that's okay. What I did was I wrote these things so that it would, and that's why these dots are here. They're not really here for here as much as they are so that they would light up here. And now if you got within 10% of the higher low, it would alert you. And once you're alerted, you look at the chart and you can see what's happened. That's why I said I'd be very concerned with corn, even though it's only it's the historical, it's not the implied. But you know, we could be getting to a situation where we're getting really wide trading ranges, which could indicate exhaustion. So I just use this as an alert. I don't even, the only thing that attracts me as a trade when I was trading was the, you know, when I got low volatility in both historic and implied on the 4-year basis, because that's a very unusual situation. And I always played it by buying straddles or strangles, and I just gamma traded it. So I would put it into the strategy analysis if you have CQG, and I'd go to the tabular, and if I saw a +1, I'd buy a future, put an order to buy futures. Got a -1, I put an order to sell a futures. And as long as the market was going up and down within the trading range, every time I bought a future, sold a futures, it lowered the cost to buy options. The biggest one we did in soybeans, by the time I actually played the move, I was no longer playing with my money. I covered the entire cost of the options because there was that much movement up and down within a narrow range, and it kept lowering my cost of the options. But what I did was it broke down. Now, I thought the down didn't have a lot of potential anyway, but it broke down, and I got out of all my futures, and I put in a stop, stop close only, 1 tick above the high of the previous bar. And I just let it go down. And the first day that I got a reversal in the futures, I bought 10 futures because I originally put on 10 straddles. So by doing that, I took the profit on the puts and synthetically turned them into calls. So now I have 20 calls, and the market promptly rallied $1, and I had 20 calls on, which would, that was a very profitable trade. Sometimes you just get lucky. I did the same thing in coffee in the early 90s. No, actually, I never did. It's the story I always tell in class. I wrote the order, and I handed it to my broker because I was on the floor. And I said, as soon as the energies open up, and I'll come over and we'll execute the trade. And it was natural gas expiration, and I got busy with expiration. And when I looked up, coffee just closed. And they had a freeze in Brazil 2 weekends in a row. That trade for 10 straddles would have cost, I think, around $28,000. In 2 weeks, it was a little over $500,000. Now, as I always laugh in class, this wasn't great trading. This was pure luck. But the situation to buy the straddle and put you in position for that had nothing to do with a freeze. It had to do with extreme low volatility. And that means that anything can make it move. And a lot of times it's a rumor. In this case, it was weather. So that's a particular trade, but you can go all year and be lucky to get 2 or 3 of them. You can go other years and get 5 or 6, depending on the nature of the market. But the commodities have been moving lately, so you're not going to see those types of situations very much. But they are things you have to look for, because as soon as they get into the media, right or wrong, as soon as they get into the media, it's not going to be a good buying situation anymore. It's going to be more of a spreading thing because it will have already bid the prices up. That's why that's the advantage of tracking the volatility. When do I?
I like that. And Stan, what was so it looks back, and you said 4 years, but one of the choices, did you say was 10-day and the other was a 20-day?
Yeah, that was historic. You see the tabs up here in the top?
Yes.
Okay, this is a 20-day historic at the bottom. Let me move it up. And so the blue doesn't change, just the red does. And then I can go up here and I can look at a 10-day. And now we're only looking 10 days back to calculate the historical vol, which is basically a standard deviation of a population as compared to the, or of a sample versus our standard deviation study with a standard deviation of a population, which is basically n versus n minus 1. So this is how we calculate the historical vol. The important part to remember here that I have a hard time explaining to people sometimes is the blue line is a normalized volatility, which means that you're not going to see a different one for December than you're going to see for February gold. We only have one for each of your each symbol, and I can tell you that I always kid everybody that it was a great option trader that came up with this idea, but then I have to admit it was my idea. I was a customer, and Harold's a guy I taught with, I also worked with, who was a sugar option. He and I were interviewed by Dmitry Bertov, who developed the implied volatility study in CQG. And he was the one that came up with the methodology to normalize it, which would allow you to look back years for the ones that we're following. And we databased the volatility based on the algorithm. And at the beginning, they're not all the same algorithms. It depends on how often there's an expiration series and things like that. So the value itself, the number itself may not fit exactly what you see as the at the money volatilities, but it allows us to bypass the normal, and a lot of people don't understand that one of the biggest things that play on volatility as you get to expiration is the fact that you have accelerated time decay. So if you have very little time to make the move, then obviously they're going to charge more for the options, because if it does make that move, the guy who sold it to you is in deep, deep problem. So it's irrelevant. And you can't look at this data very well if every expiration you get this big spike. So
it's eliminating the skew.
Yes. The skew, not the skew between the puts and the calls, the skew you get caused by an expiration or the interplay between time decay and volatility.
Gotcha. Okay.
It's different.
See, now, Judd,
call skew.
Look, now, Judd, remember today McClellan sent out, because we're looking at, oddly enough, we're looking at silver here. And today McClellan, because Judd sent it to me, it's like, oh, it's a blow off top in silver. And from the looks of this, if we look, maybe that's the 20-day. Stan, is that the 10-day?
20.
That's 20.
That's a 10. 20?
No, it's 20. The first one's 20 because 10 is the one I added.
All right. So can we look at the 10?
Sure.
Let's just look at the 10-day.
Now you'll notice that the implied volatility historic is higher because it's a shorter term, so it caught this move, increased the historic volatility. So, but it's nowhere close to the high if you look this way. But if you eliminate this and look to where it has been, it's been about 45, and it's at 40. It's at 49 now. So if you eliminate this thing, it's getting pretty close to where it had been for almost a year before it blew off here. But it's nowhere close to what happened back back here in March. Well, that's when everything went down in March.
So Judd, what Stan just said. All right, so Judd, that tells me that McClellan stuff was bullshit.
Well, I think all this stuff is bullshit.
Because what Stan just said is we're we need to, these levels need to get higher in the historical and the implied before you're reaching a danger zone or a warning zone.
If it does start to come down, that will increase your volatilities dramatically. But the longer it stays sideways, we've had an inside day today. You know, the longer it stays here, the more the implied volatility is going to come down.
But, and Langer wants to buy it at 2160. So you can see right where that horizontal line is right where you want to pick it up.
Well, remember this horizontal line is not set up for silver. I'd have to put it in.
Okay. But even so, if you can see the purple line, it's going to basically come back to that that would be back to the averages.
Let's take a look at silver real quick. And this is why I did this, because for a lot of futures traders in particular, we're so used to looking at charts that let me do 33 again, and this time it's at 44.18. Okay. So we can go in here. Now there's two different studies. I want the one where we're putting in both the days to expiration and the. Okay, so let me just see. That's good.
See, Stan, I like this volatility chart here because everybody's got charts, right? You just said, the futures traders are all looking at charts,
Right?
Right. Everybody's looking at charts. They're looking at 50-day averages, exponent EMAs, simple moving, all that crap. Everybody's seeing the same thing. So, the trick is to go look in places that they're not looking.
Right. Well, that's exactly correct.
But then again, Angelo, most of these guys, 99% of them are looking at the wrong charts.
Even better.
Yeah, well, we've proven that.
What I'm saying here is, if you're looking to buy, especially if you're based on based on the implied volatility that's being traded right now, the purple line is the trading range that's being projected for the next 33 days in silver at this implied volatility. So if you think this market's going to go up and you want to buy calls, you better really kind of make sure you think it's going to go higher than the purple line. And that's why I said, otherwise you look at a spread. You buy it here and maybe you sell a call here. That lowers your profit. It caps it, but it gives you a finite risk and a finite reward.
So Stan, that's your strategy, given the fact that it's smack dab in the middle?
Well, no, this is always going to be in the middle. It's because this is in the middle.
Okay, got it. This
is always going to be middle because it's giving you a deviation up and a deviation down. So this moves with the close of the market. See, and now I could go in also on this, and I could do the next month out, and I do that. That's why there's more than one there. I can go out here and.
So you want to go to not October, but this is going to be the next active month.
Yeah, if you want to go that far out. But again, I'm looking for trading ranges.
Right.
But you can see how much this is going to be, 123 at 41.70. So we go back in there on the D's, and D's would be good for me because, I like to go out further. So, so you go in here and you put in 123, and here you put in 41.70. Now, and this is why people buying options don't always do so great. You know, you're looking for a move that would take you higher than this or lower than this. And by the way, you get basically the same numbers if you look at a put and a call right at the market, at the money put and at the money call. If you add up the premium on the two of them together, you're going to get this same number. It's just another way of looking at it. So that means that you have to make more money than you paid for the put and the call. And this is the trading range that's being projected. Now you can put that into perspective. What's interesting to me with a lot of these is a lot of times when you do this, you find out that these numbers go right. If you go back, these are new highs, so it's different. But in a lot of places, this line is a perfect swing high. These options are not being priced without the knowledge of what people think the market's going to do and what the trading range is. And always think about this as how are we compensating the seller? And as the implied volatility goes up, the higher the probability that the market's going to go, you know, in one direction or the other, the higher the premium goes, because the more protection the seller wants or needs. Because remember, the buyer can only lose what he pays. The seller has unlimited loss potential, but the probabilities are in favor of the seller. So, but something comes for that risk. So so I like to look at this and give me an idea of what the options traders are willing to pay for and what trading range they're protecting themselves for.
Now, Stan, on Monday, the standard deviation range here is going to change. So you need to make a mental note or write down, like if you implemented your trade today,
yeah,
then you've got to make a note of the 28.76 and the 25.78, I guess, right?
Yeah, I would keep an idea on it, but at the same time, as it recalculates every day, you're going to see where you are on your positioning compared to that trading range. And, you know, if the market's going up, you know, the bottom line, even though it may be higher or lower volatility, will be moving up. So you're almost like a trailer of your risk parameters. And,
gotcha.
And let's face it, as it goes up and you remeasure the volatility, it also means your target's going up, because that, as you say, the upper line is being recalculated every day. So it gives you perspective of where you got in. And as the market goes up, at some point you're going to end up being below this lower line if you go far enough. And in essence, it's going to be you know, a very conservative trade at that point, because you could put a stop in there, and you know, and you're safe. I just think I always thought it was valuable information to a trader, even if they don't trade options, is understanding volatility and what it tells you.
That was very cool. Thank you.
My pleasure.
Good stuff.
When you go back on this, just to make sure, Judd, when it says, do you want to save changes, say no.
Okay.
It'll go back exactly the way we had it before.
Okay. Oh, if I try to change a page?
Yeah. You have it so that it says, or you took that off, so it doesn't ask you if you want to save changes.
Oh, there it is.
It doesn't matter here. I can do it. I know it. Let me just open up the other, see if I can open up the other quote monitor. Oh, here. And then just right click and tile. I just want to make sure that I have the right one in the right place.